Welcome back. Here to talk more about potential bank fallout from the collapse of the SVB is Julie Biel, portfolio manager and senior research analyst at Kayne Rudnick. She's also a CNBC contributor. Julie, it's good to have you here this morning. Markets waiting on the European Central Bank for sure. We're stepping in front of that a little bit. But as you survey the landscape, see some regional banks still under a lot of pressure. But the NASDAQ, for instance, holding up relatively better. What are you thinking?
Well, I think overall, this is definitely a time where investors need to take stock of their holdings and think about, do I have the right quality names to weather this kind of a storm? Because it's very unclear to me how this bank fallout is going to reverberate. I think obviously our largest banks have been amply stress tested. It's very clear that they're well capitalized, but the regional banks, it's a little bit less clear. You could have pockets. I think you could continue to see pockets where they've been impacted by crypto or certain types of lending. And so, that has me concerned. As an investor, I've never been very interested in banks. It's really hard to differentiate if you're a bank and you have this mismatched duration, which is really starting to hit right now. And like, frankly, I am too dumb to read those financial statements. I'm a cash flow gal.
Well, it raises the question of, can anybody really get to the heart of the complexity? I think someone yesterday on our show was highlighting that Morgan Stanley's trading at the same price it was 20 years ago. So it's not like you've really missed out either by focusing elsewhere. So what is that elsewhere right now? Where do you feel with looming recession probabilities? Like I said earlier, Goldman's up to 35% this year. Where do you feel more comfortable?
Well, I think, what's been nice is you had a sell-off in some of the higher quality names. And, they've been for various reasons. So if you think about, the COVID fallout, I would think of, a name like a West or a Zenta that benefited from COVID revenues, but the core business is still really strong, unlike, say, a Peloton. So I think there's opportunities still in quality businesses. You just have to be really picky. And I would focus on companies that existed in the last financial recession so that you can look at what the historical financials were.
Interesting. That kind of removes a large segment of the market, actually. What about energy, where this was supposed to be one area kind of benefiting from supply-demand imbalance, Russia war in Ukraine, China reopening, all the rest of it, and yet crude prices have really disappointed this year?
Yeah, I think it's been interesting, the moves that have been happening in the oil markets, right? Because it's not just, the story on the demand side, but also the story on the supply side. For us as investors, we're long-term investors. And so it's really hard to get excited about anything in energy when so much of it moves based on geopolitical events that you absolutely cannot predict. So for us, that's not really a space that's very interesting.
And we have the Fed coming up, which, casts kind of that shadow across all of the markets. Weigh in, if you don't mind, on the whole debate. Should they or shouldn't they hike next week?
I think it could actually spook the markets if there is no interest rate increase, because they've been so clear that there will be an interest rate increase. We thought we were going to be up 50. So I think a 25 basis point increase makes sense. Something that wasn't really reported yesterday was, the GDP Now forecast out of Atlanta yesterday revised up to about 3% for first quarter GDP. That's pretty healthy. And, the labor market just isn't cooling in the same way they would like. Shelter is still very hot and will take time. I think Chair Powell talks a lot about the crude tools that they have. And I think, they have to use them. They can slow down some of the quantitative tightening. But other than that, I think they need to hold the line.
I'm looking at Andrew for, I want outrage. I want him to say, no, Julie, no, that would be.
Well, that's what I can't figure out. Are we raising interest rates just to raise interest rates because of our credibility? And if we say we're not raising interest rates, that everyone says, okay, then something really bad is happening. And is this like a pretend situation where we're pretending something's happening that's not really happening? Or is that the right thing to do?
Well, I think if you think about the Fed, right, there's a dual mandate, right? And that's towards employment and inflation. And inflation is still running too hot. It's uncomfortably hot. And, I think we all kind of understood that it would be very hard. It would be easy to get from, 10% inflation to about 5% inflation. It's going to be very hard to get down back to the 2% inflation. And so I think the risk of stagflation is really present in their minds. And so for them, they would like to have as much ammunition in terms of interest rates to quell inflation and then have the ability to cut. They've certainly been very good at cutting in the past.
Right.